So the next reading in risk and investment management talks about how war and risk budgeting should be used while constructing our portfolios. So risk budgeting essentially is the exercise of deciding how much risk to be taken and how to allocate that risk amongst fund managers and amongst portfolio managers. So risk budgeting is a top-down process that involves choosing and managing exposures to risk. Now, compared to banks, that is considered the sell side, so banks and proprietary desks of investment banks generally sell their services to long-term investors and other investors. So banks and sell-side firms have a shorter horizon, have higher turnover and higher leverage as compared to buy-side investors like mutual funds and other portfolio management companies that have a longer horizon, slower turnover and lower leverage. So historically, buy-side firms, that is mutual funds, etc., have used measures like tracking error, benchmarking, active return and investment guidelines, sector limits, etc., so as to measure and manage their risk. Banks, on the other hand, and hedge fund type institutions use more forward-looking measures like war and war limits. So these investors seem to be using war more and more. So traditionally, these institutions have seen to be using war more than the buy-side firms like mutual funds, etc. Increasingly, investors are relying more on war because of higher globalization and the standard interpretation of war that is common across asset classes, and the increasing complexity and the dynamic nature of the investment industry. So simply measuring risk from standard deviation and historical measures is no longer adequate. So increasingly, more and more, we are calculating return on war and trying to compute the war of the various positions. Hedge funds have characteristics that make them more similar to the sell side of the industry. So even though hedge funds are also buy side institutions, that is, they buy the services of the sell side, the characteristics of high use of leverage and high turnover is similar to banking and other institutions. So they have additional risks like low liquidity and low transparency. So again, low liquidity leads to problems in measuring the risk because it puts a downward bias on the volatility and the correlation. So if the price remains the same for many days to come, then the volatility will be downward biased, not because actually there was no volatility, but it's just because of the low liquidity, no trade happened, and because no trades happened, the value didn't change. So volatility tends to be downward biased, enhancing the returns or making it look like the returns have been better than what they actually are. Various types of risks need to be measured and managed. Absolute risk is the possibility of total or absolute loss over the investment horizon. Relative risk is measured by excess return or the loss relative to a benchmark. Again, war measures can be used to calculate both absolute and relative risk. Risk from the policy mix is that the chosen portfolio weights may not give us the desired return. So if we decide 60% and 40%, then again these chosen policy weights may not give us the right return. That is the policy mix risk. Active risk further comes because individual fund managers may deviate from these chosen portfolio weights. So even if the policy weights did work, because of individual managers deviating, there can be some active risk. Funding risk is the risk that the value of the assets will not be sufficient to cover the liabilities. Very important for pension funds, in which case the liabilities are fixed, and as the value of the assets fluctuates, the value of the surplus or the value of their ability to meet the liability will fluctuate. In applying war to such situations, the manager will add the expected increase in the surplus. Surplus is defined as the assets minus the liabilities of the fund So in a pension fund, the pension liabilities are fixed because you've already guaranteed people a fixed salary until they die, whereas the assets can keep fluctuating. So we add the expected increase in the surplus and subtract the war of the assets from it. So the war of the liabilities is assumed to be 0 because the liabilities are assumed to be fixed. So whatever is the war of the assets will become the war of this surplus. Difference between the expected surplus and the war is the shortfall associated that we'll study with an example. In case of pension plan, there may be sponsor risk also. So it is often the sponsor's responsibility to fund the pension plan. So if I am a steel company, then I as a steel company from my profits may be needed to fund the retirement benefits for my employees for the future. Sponsor risk is the risk that the sponsor, that is the steel company, will not be able to provide funding for the pension plan. So there can be cash flow risk, which addresses the variations of the contributions to the fund. So the steel company or the sponsor may not be able to contribute funds as are needed to meet these liabilities. And economic risk, which is the variation of the earnings in the sponsor that can again happen because of the returns from this pension plan. So we'll study funding risk in more detail. The ABS retirement fund has $200 million in assets and $180 million in liability. Assume that the expected return on the surplus scaled by the assets is 4%. So this is 4% of the assets is the expected return. So the surplus is expected to grow 8 million, that is 4% into $200 million, that is $8 million is the expected growth in the first year. The volatility of the surplus is 10%. Using a z-score of 1.65, compute the war and the associated deficit that would occur with the loss associated with the war. So the current surplus is the assets minus the liabilities, that is equal to 200 minus 180, that is equal to $20 million. The expected surplus is 20 plus 8, that is the $8 million return, 4% of 200 that is given, $28 million. Volatility of the surplus is given to be 10%. Please note the volatility of the surplus is coming from the volatility of the assets. So what will be the war of the assets? It will be the z-score, that is 1.65, into the volatility into $200 million. So in a pension plan, we assume that the liabilities are fixed, that is the liabilities don't have the volatilities. However, the assets can be volatile because they'll be invested in stocks, bonds, etc. So the volatility of the assets is assumed to be 10%, so that the war of the assets comes out to be $33 million. So in the worst case, the war will be a loss of $33 million, or rather in the 95% case, the associated deficit in that case would be an expected value of the surplus of 28 minus the decline in the value of assets, that is 33, which will come out to be $5 million. That will be the value of the deficit. The ABS retirement fund has $200 million in assets and $180 million in liabilities. Assume that the expected return on the surplus is 4%. This means that the annual growth rate of the liabilities is 3%. Also assume that the volatility of the asset is 10% and the volatility of the liability growth is 7%. Compute 95% surplus at risk, assuming the correlation between the asset return and the liability growth is 0.4. So in this case, we are not assuming that the liabilities are fixed. So if the liabilities also have the volatility, then remember that the variance of A minus B is given as WA square sigma A square WB square sigma B square plus 2WA WB, rather minus 2WA WB covariance of A and B. If the weights are the same, or it's A minus B, then you can simply say this will be the variance of A in dollar terms plus the variance of B in dollar terms minus 2 covariance of A and B. So in this case, variance of A is given to be 0.1 square, variance of B is given to be 0.07 square, minus 2 times the covariance of A and B will be 0.4 into variance of A into the variance of B, because the surplus, please note, is given as assets minus liabilities. So this will now be the variance of the surplus that we have calculated, and we can compute the VOR of the surplus now as 1.65 multiplied by the sigma of the surplus, that will be the square root of this value. So please note, for the absolute value of the variances, we'll have to multiply 1 square with the value of 200, similarly 0.07 square with the value of 180, minus 0.1 into 200 into 180. So this will give us the dollar value of the variance of the surplus. The expected return on the surplus can again be calculated as the expected return on the assets minus the expected return on the liabilities. So expected return on the assets is given to be 4% into 200 million, that is 8 million, minus the expected return on the liabilities will be 3% into 180 million, that is 5.4 million. So the expected return on the asset comes out to be 2.6 million. The volatility of the surplus multiplied by 1.65 comes out to be 31.18 million, or the 95% surplus at risk can be calculated as the expected return minus the VOR of the surplus, that will be 2.6 minus 31.18, which will come out to be 28.6 minus 28.6, or $28.6 million is the surplus at risk, or that is how much the value of the surplus can decline in the coming period. In the worst case, that is if the 95% event plays out, then the value can decline by $28.6 million. Expected growth minus the loss. That is the expected growth minus the loss, that is approximately $28 million. Risk monitoring is again a very important activity to catch rogue traders whose activities may go undetected with simple periodic statements. So it is also needed for passive portfolios because the risk characteristics of the benchmarks can change. So risk monitoring can help determine why changes in the risk have occurred. There's a trend globally towards using a custodian that aggregates the risk across countries and across different portfolios. So the goal is to move towards centralized risk management and help aggregate the risk of our various portfolios, which is very important for especially for larger firms. So custodians can combine reports on changes in positions with market data and can produce forward-looking risk measures. Basically, more analysis can be done if there is access to losses across the world and there is access to returns and positions across portfolios. So those that choose not to use a global custodian have done so because they feel they have tighter control over risk measures and can better incorporate war measures or war systems into their operations. So hence they want to still keep it decentralized at their local level, and they don't want a global custodian to measure and manage the risk. More and more we are seeing that managers are incorporating war systems into their processes. There's evidence that managers are differentiating themselves with regards to their risk management systems, and those that do not use good risk management systems are increasingly becoming at a competitive disadvantage. So war helps move away from the ad hoc nature and the overemphasis on notional values and simple sensitivities that characterize the guidelines that many managers now use. So these guidelines are often cumbersome and ineffective in that they focus on individual positions. They can easily be circumvented and anyways do not capture the overall risk portfolio or overall risk profile of the firm. So war is useful for the investment processes. So when a trader has a choice between two new positions, the trader can compute the marginal wars to make the selection. Whether deciding to increase one existing position over another, the trader can again compare the excess return to the marginal war ratios and increase the position in which we saw earlier. Also, we have a higher excess return to marginal war. Budgeting risk is a very important activity. So this means selecting assets whose combined war is less than the total allowed. So if total allowed war is 100, often we may be able to take 3 positions of 50, 50, 50 each. And because of the low correlations, the combined war may be much lesser than, it will definitely be less than 150, but it can even turn out to be less than 100. So we'll be maximizing our return while staying within our war limit. So the budgeting process would examine the contribution each position makes to the portfolio war and would include the benefits of diversification. So let's understand with an example. A manager has a portfolio with only one position, a 500 million investment in W. The manager is considering adding a 500 million position X or Y to the portfolio. The current volatility of W is 10%. The manager wants to limit the portfolio war to $200 million at the 99% confidence level. Position X has a return volatility of 9% and a correlation with W equal to 0.7. Position Y has a return volatility of 12% and a correlation equal to 0. Determine which of the two proposed additions, X or Y, will keep the manager within his risk budget. So there are 500, 500 again, and the correlation is given. So we can again just simply apply the formula that the war for the overall portfolio will be equal to the war of position 1 plus the war of position 2 plus 2 correlation into war of 1 into war of 2. We could do it like this, or we could compute the sigma of the entire portfolio with that elongated formula and then do 2.33 into the sigma into portfolio and then again see, or rather multiply it with 1000 million or 1 billion, again see which of the two methods gives us a war estimate of less than $200 million. So with a $1 billion portfolio, if we add X, please verify that the current war of 116.5 will become a total war of 204 million, hence the value will get exceeded. Whereas if we add Y, the correlation is given, the war will then become 182 million. So portfolio Y keeps the total portfolio within the risk budget. In the previous example, demonstrate why focusing on the standalone war of X and Y would have led to the wrong choice. Why? Because diversification benefit would have been ignored. Individually, or the individual VARs can be very high, but that doesn't matter. We have to see that what is the addition of VAR to the portfolio. If correlation is low, then our risk will not go up, because even if one asset falls, the other does not fall, or the other goes up, and when one goes up, the other falls. So if there is a negative correlation, then the risk reduction is likely to happen, and hence the VAR may even decrease. Or if we ignored the diversification benefit, we would have miscalculated our total VAR. Finally, it can also be shown that within fund managers, the optimal allocation will be achieved when the weight of portfolio managed by manager I is equal to the information ratio of manager I upon the information ratio of the portfolio multiplied by the portfolio's tracking error upon the manager's tracking error. For a given group of active managers, these weights may not always sum to 1. In such a case, the remainder can be allocated to the benchmark which has no tracking error. So remember that the optimal weight of the portfolio managed by a particular manager is given as the information ratio of that manager multiplied by the portfolio's tracking error, that is the standard deviation of the active return, divided by the information ratio of the portfolio multiplied by the manager's tracking error. We have manager A, manager B, who have an information ratio of 0.7 and 0.5. We can compute the optimal weight for A, which will come out to be the information ratio of manager I, that is 0.7, into the tracking error of the portfolio divided by the information ratio of the portfolio multiplied by the tracking error of the manager. So for manager A, the optimal weight comes out to be 51%. Similarly, for manager B, the optimal weight comes out to be 37%. 12% we will say can be allocated to the benchmark. So remember, it is the information ratio of the manager divided by the information ratio of the portfolio multiplied by the tracking error of the portfolio divided by the tracking error of the manager. That will be the optimal weight that should be allocated to the active managers.